In today's video, I am going to be breaking down my favorite tech dividend ETFs. So let's get down and let's check these out. So this first one is the Global X S&P 500 Covered Call ETF. It is XYLD. Now you're probably saying, this is not a tech ETF. Why are you covering this ETF? It is mainly because of its top 10 holdings. Now its top 10 holdings only do cover 30% of its total assets. However, the top 3 companies are tech. Then it goes to Facebook, Google. That's now 6 out of the top 10. We then have Tesla and Nvidia, and I personally classify Tesla as a tech company. So literally 8 out of the top 10 are tech companies. To me, even though this is in a broad S&P 500 ETF, the S&P, its top companies are mostly all tech. So what does this ETF have that others don't? Well, first off, it's a covered call ETF. Basically, it's when a covered call is when you hold a stock and essentially you are selling an option to somebody to buy that stock at a future date at today's price. However, that person can only buy that stock if it reaches a certain point. If it doesn't reach that certain point, you keep your stock. That person loses the premium they paid, which is the chance to buy that option to then, of course, buy those shares in the future. They call that a premium. And then, of course, you keep the premium, and that's where you get the massive dividend from. So if you want to essentially visualize this, let's say we have Apple stock, and let's say we have 100 shares. We sell an option to a person to buy Apple shares at today's price of, let's say, $100. However, for that person to buy those 100 shares at $100 each, they would have to have those shares reach, as an example, $120 per share. If they don't reach $120 per share, we keep our 100 shares, and this person originally paid, let's say, $150 altogether, which equals about $1.50 per share, to buy those shares. They lose that $150, we keep that $150, we keep our 100 shares. That person no longer has the ability to buy them, and they are sad. It's almost kind of like gambling. How I like to explain options is like educated gambling. The average share volumes for XYLD is 130 shares traded per day, and its expense ratio is 0.6. Now you're probably saying, wow, that's really, really high. Well, actually, for a covered call, it's not that high. And before you're saying, well, there's no Canadian ETFs on this list, there is, and they're going to be later. The yield on this, however, is a massive 9.5%. That is huge. However, let's look at the chart and see if there's any patterns we can see, and actually look and see if we should invest right now. Well, if we look over history, we're sitting roughly currently about halfway through the ups and downs. This could be a good chance to buy if we look at the immediate 5-year history of this ETF. The lowest obviously being COVID. However, the lowest before that was around $45, the highest being $52, and it's currently sitting at $49. If you wanted to buy this ETF right now, this would be a good time because, of course, it's not hitting its all-time high that it's hit almost 3 times. You're sitting right in the middle. Could it expand past this point? Yes, it could. However, what we do see here is a pretty standard top that it may have some issues trying to get past. It generally then goes down to about $47.50. So you could legitimately buy this right now and then, of course, wait for it to get back down to $47.50 and buy more, and then sell it at 52, or just keep on holding it because it pays over 9% when it comes to dividends, which is a nice payment. ETFs like these are a great option for you to get if you're looking for income replacement, especially being close to 10%. Let's call it 9% to make it even easier. If you're investing $10,000 into an ETF like this, you're going to be making back around $900 a year, which is huge. Think of now investing $100,000, you would then get over $9,000 per year in income. Now, we also do see how the dividend is paid, which it is paid every single month, which is absolutely amazing. And if we look year over year, we do see an increase on the dividend as well, and we generally like to see that. Its top 10 holdings are mostly, like I already mentioned, all mostly tech, even though it's not a tech ETF per se. And then the next ETF is Qyld. This is another interesting one. It pays 11.8% when it comes to the dividend. Again, 0.6% MER, and this one has some pretty crazy average volume as well. But look at that yield, 11.8%. Over the past 5 years, we've seen it range from about $22 up to about $25. Then it went down back in the end of 2018 to $21, and we can see that it hit $24 recently before, of course, the big massive plummet, and it's pretty well leveling out right now, roughly where it usually levels out before it goes back up to these high points. What this tells me is this could be an interesting time to buy. It did just recently hit what looks to be a double bottom, which could be a good time to buy. Of course, this is what you're buying is the dividend. And when we start looking at an 11% dividend, for every $1,000, you're getting $110 per year on average. When we start looking at, for example, of $10,000, you're looking at $1,100 a year, almost $100 a month. And then when you start investing something like, let's say, $100,000 total, you're now making over $11,000 per year. That's almost $1,000 a month. That is life-changing. It does also pay every single month, and if we look and check out year-over-year numbers, June to June as an example, we do see a slight decrease. However, July to July, we do see a slight increase. Even though this is only a one-year period and 2020 was a struggling year, we still see some pretty nice dividends, and it pretty well levels out to be around 20 to 22 cents per month per share. Its top holdings are obviously all tech: Apple, Microsoft, Amazon, Facebook, Alphabet, Tesla, Nvidia, Alphabet again, and PayPal. Now we're going to go over to a Canadian ETF, which is the CI Tech Giants Covered Call. This is TXF. Same idea as what we were looking at for Qyld, it's just the Canadian equivalent in my own opinion. You can see how it's had some pretty crazy growth as well, which is absolutely amazing. And since inception, if you reinvested the dividend, it's also doubled its value, which is huge. And what you're going to be getting is the option premiums plus the current yield for the stocks that are in the ETF, which together combine to be well over 7%, close to 8% at one point when the stock price or the actual underlying price of this ETF, at one point, this ETF's dividend was well over 10%. So absolutely fantastic still. What we really want to see here is, of course, an increase every year, or at least a hopeful increase every year. Of course, 2021 is not over yet. And what we are seeing is, of course, some nice growth in the dividend. They also have a couple of years where they gave a dividend plus some reinvested dividends as well, which is also nice to see. And its top 10 investments is Applied Materials, Micron, Intel, Alphabet, Booking Holdings, Broadcom, Intuit, Microsoft, Nvidia, and Texas Instruments. So it is a different list than what you see in Qyld in the States. That's also the underlying year-over-year returns, which is absolutely fantastic. Some of the best years were last year, the year before, 2017, and 2013. 2018 and 15 not being so great. And of course, over the past 5 years, we can see that it's raised from about $10 to $22, which is amazing. And these are the past dividends. We can see that they do tend to rise, recently going super high, but overall very good. BMO also has their own equivalent, ZWT, and this one is again the same strategy as what the others were using. This one does only pay 4.5%, however, and its management expense ratio is quite high at 0.7%. It does also distribute monthly. This one does distribute about 13 cents per share. There is one thing, however, that gets me excited, and it's not just the holdings. Of course, the holdings are extremely strong. Alphabet, Microsoft, Facebook, Apple, Amazon, Nvidia, Visa, MasterCard, Adobe, PayPal, all very good companies. But what gets me excited, even though it's a very small sample size, is it's gone from $30 a few months ago to $34 today, and it does hold different holdings than ZWK, so you could legitimately hold both of these if you're Canadian and do quite well. I hope that this video has helped you in your investment journey. If it has, hit that like button, subscribe. Let me know down in the description your favorite out of all of these. I'll see you guys again next time.